Good morning, good afternoon, good evening. My name is Rose Joshua. Welcome to Family and Finance, where we provide you with lots of information, free information to help your finances. Today, I'm going to talk about your net worth, and I'm going to use a couple of examples to illustrate how we can grow net worth and how sometimes they compare one with another. It's always good to have a combination, but let me share my screen just so I can jump into it. So today is about net worth, and I'm going to focus on the real cost of rental properties. A few people have asked me to talk about how, they can make money from rental. And so I have done a bit of analysis to see how that could work and what might be some of the things to be cautious about. So I'm going to talk about that, but also compare that with stock investments and insurance. So your net worth is your assets minus your liabilities, dead or alive. And people grow their net worth using different things, different techniques. No single tool is the best. We can use a combination. So different instruments grow differently. So some grow fast, some increase your net worth immediately. Some increase your net worth slowly over time. So it's really key for you to understand the different instruments that you use and how quickly they increase your net worth, especially because you want to take care of the risk of premature passing away early. So we're going to explore three different scenarios, three different tools. We're going to look at rental properties versus insurance versus stock investments for the same person or triplets, all other things held equal. So we want to assume that everything is the same for these three scenarios, except for the rental properties, the insurance, and the stock investments. So when it comes to rental properties, there's a few mistakes that I've found that people make. So we're going to look at some of that. One of the primary mistakes is that people forget the real costs of rental properties. So it's very common to see somebody say, you know what, I bought this unit for 100,000, I sold it for 400,000. So they assume that the gain is 300K, but that's actually not the case. So we're going to look at the underlying costs, and it's really important that you pay attention if you're thinking along the lines of rental properties. The idea is not to discourage you. The idea is to provide clarity around different forms of investment, so that way you can plan your allocation of funds correctly. All right, so I'm going to do a demo. I'll jump into a spreadsheet. So in this spreadsheet, I'm looking at a rental property, like an apartment or a small townhouse at $202,500. I'm assuming 30 years of amortization, and I'm going to play with this number 30. So let's say you're in Alberta, for example, and you want to buy this property, you would have to put down 20% as an investment deposit, down payment. And so you'll be spending $40,500. You pay lawyers in order to close the deal. So I'm assuming 1% of that, $2,000. And so your pre-CMHC balance will be $162,000 after taking out the $40,500 down payment. So there is no additional CMHC fee because you've paid the 20%, so it's waived for you. It's there, but it's waived for the consumer, right? And so your mortgage then becomes $162,000. Now I want to assume, so this is, let's say it's a 2-bedroom condo. And I want to assume that you're collecting rent of about $1,500 a month. And I'm also making an assumption that occupancy is about 80%. So the reason for that assumption is because there are times when you could have vacancy, and so you're looking for tenants during those times, or or even when you're making repairs, and so there's nobody there. So 80% occupancy. Now, the mistake I talked about earlier is a lot of people look at, okay, I'm collecting rent, $432,000, so I'm making good money, but then there are underlying costs, and we're going to talk about that. So cost number one is the interest on the mortgage. Remember, it's a mortgage. So even though you put down 20%, you are paying the interest on the mortgage. So in this case, I'm assuming 5%. I'm actually on the low side of things. So I'm assuming 5% compound interest. And so simplifying it over 30 years, about $120,000. So check your interest calculator. It's about 122,000. So 121.5 here. And so I'm basically, I put in a formula in this spreadsheet that approximates the compound interest using simple interest. Don't mind me, math, right? So that's simple interest kind of approximates to 2.5% simple. All right. So now the other cost is your condo fees. Remember that although you're collecting money from the tenant, you yourself have to pay the cost of the property. So you will pay your condo fees. So I'm assuming 1.5% is actually 1.5%. What's this formula? Yeah, 1.5% of the price of the home. Okay. So if you look at it, it's 1.5%. Let me pull up a calculator to actually see. If I do 202,500 times 0.015, so that's 3037 divided by 12, about less than $300 a month. Now this may be on the low side. I've seen condos that pay $300 plus $400 a month. So we're actually being quite generous here with this expense. Okay. All right. Next cost is your property taxes. So remember, you have to pay property taxes, and they differ. They differ with different municipalities. So you want to check with your municipal government your property tax. I'm assuming 0.6% here over the number of years. So we're assuming 30 years in this case. So that's 36,450 here. Now, special assessments come in from time to time on condos as the condo ages, as they do the reserve fund studies, and so they would assess for repairs, for instruments like boiler could break down, and they basically have to plan in advance for maintaining the condo complex. So I'm assuming here a general 5% overall over time. This may or may not be low. It just depends on the condo. Some condos assess high, some don't. It just depends on management sometimes also. So I'm just making this assumption here, several assumptions. So for rental repairs, I'm assuming 0.25% overall. And for pre-sale touch-ups, I'm assuming 10% overall. So for pre-sale touch-ups, let's say I'm making an assumption that this person passes away after 30 years. And so there has to be a sale, and the The touch-ups would include maybe replacing your appliances, replacing the flooring, repainting the house, replacing the bathroom, stuff like that. Remember, there's people who have lived in this property for many, many years. So now, the big one is, how much will this house be sold? And this is a big question because it depends on your city. We see what happens in different cities, in Vancouver, in Toronto, Edmonton, Calgary. So depending on where your property is located, no one knows what's going to happen in 20, 30 years, right? But I've put in a formula here that assumes a 5% increase year on year. So it may or may not happen for you, but this is actually quite generous. So 5% increase year on year. This means that over 30 years, this property started at 202,000. And now I'm assuming I'm selling it for 875. So that's selling it for more than 4 times the value. Now, is it realistic depending on your neighborhood? Maybe not. So we're going to play with different numbers here. Okay. So when you sell the property, you do have to pay realtors unless you want to keep it on the market for a long time and do for sale by owner, and then maybe get less value. So if you do for sale by owner, in many cases, you're getting less. So you might as well get a realtor, is my recommendation. They are experts. They can help you get the job done better. And then you have lawyer fees, of course, to close. And because it's a rental property, you do have capital gains or capital losses, depending on how much you sell it for. So in this particular scenario, the total expenses is about $600,000, and the total revenue is about 1.3 million. That's the rent plus the sale. And so your net gain is about 710,000, which comes to a rate of return of 120%. Okay. So this is assuming that the person actually is there for the longest time, for the whole 30 years. Now, what happens if the person passes away after 10 years, for example? Let's say 5 years. 5 years, I change the number here. So all my formula actually change when I change that number. So after 5 years, you're sitting at a net gain of 178,000 and a return on investment of approximately 120%. If it's 10 years, you're sitting at about 254,000, again, rate of return of about 120%. 15 years, you're sitting at about 341,000, again, rate of return 115. So it's quite stable. The rate of return is approximately stable. And then say 20 years or 25 years, rate of return is still around that 120. So regardless of where it's at, just the way we've identified the underlying factors and the way we've made the assumptions, is sitting at around 120%. Now, if your real estate does not appreciate as fast, so if I change the formula here from 5% year on year to say even 4% year on year, your rate of return is affected right away. So then your rate of return drops to 99%. Okay. All right. So again, if you have a rental property, it's good to know that apart from your down payment, there's other expenses. So the lawyer's fees to close the purchase, the lawyer's fees to close the sale at the end, the actual mortgage, interest over time, condo fees, property taxes, special assessments, pre-sale repairs, realtor fees, and of course, your capital gains tax. All right. Any questions, feel free to call me and you and I can have a one-on-one to help you better understand this. So that's looking at the real estate side. So my original cost in this example is the down payment, which is an upfront $40,500. So the second scenario I'm going to look at is, what if this person takes the $40,500 and applies it to another scenario, another type of instrument? So now let's look at, let's say the person uses it to buy insurance. So because of the annual limit on deposits for your permanent insurance, I'm assuming that the 40,500 is spread over 3 years. So this is 13,500 a year for 3 years, and the insurance is paid off for $500,000 with $500,000 with account value. And I will spend some time on this type of death benefit next week, I believe, is the plan for that. So the rate of return, if the person passes away in 5 years, will be about 1,255%. Rate of return in about 10 years is 1,288. Again, rate of return after 30 years is about 1,723. So the actual value after 30 years is about 738,000. The actual value after 5 years is 546,000. If you want to compare that with the rental property, for example, let me go back to that one. After 5 years, the actual money that goes to the beneficiary is sitting at about $169,000. Okay. So compare that with, after 5 years, this is sitting at 548,000, right? So the difference is a lot. But that is because, like I explained earlier, some instruments appreciate faster, some do not appreciate so fast. So some take time. So real estate is one of the ones that take time depending on your market. Okay, so that's second scenario, using the same $40,000 to buy life insurance, fully paid as quickly as possible. The third scenario is using your money to invest in an RRSP or TFSA. So I reached out to Ontario Securities Commission and they gave me permission to use the compound interest calculator for educational purposes only. So that's good. So I'm going to use that. So here's my $40,000 initial investment with nothing added, 8%. Okay, I'm assuming 8%. And the reason I'm doing that is because the insurance example, I'm using 7.72%. So I'm rounding that up to 8% per annum. And that is compounded yearly for 30 years. And if you calculate, the final amount is $407,000. So after 30 years, it's sitting at $407,537. After 30 years, the insurance example is sitting at, what's the actual amount now? 738. And after 30 years, the real estate example is sitting at 537. No, that's because I changed the formula here. Let me put that back. I'm increasing that by 5% again. So it's sitting at 709. So it is actually close. The real estate one is close to the insurance example. But let's go back to the compound interest example at 8%. So your rate of return here is, what is the rate of return? The rate of return in this example is, we started with 40,500. The final amount is 4075. So the rate of return is 906%. So you gotta be careful, you gotta pay attention to your rate of return in the sense that how much money are you actually putting in, how much money are you getting out. So even though in the real estate example, it sounds like a lot of money, but how much money are you putting in and how much money are you getting out? So in the real estate example, you're spending about 600,000 and your net gain is 709. So if the person who did a stock, say TFSA or RRSP, spent as much as 600,000, they will be getting a lot more because the rate of return in the real estate side is quite low. So your rate of return here is 120%. For your stock investments, your rate of return is your rate of return for your stock investment is 906,000%, 906, and your rate of return on the insurance is over 1,000%. So again, you need to watch the rate of return. So I think that about covers it. Oh, the other thing I wanted to show was, this is a 30-year return on the RSP. If you want to look at the 10-year mark, 10-year mark is only sitting at 87,000. So that's not a lot of money. 20-year mark is sitting at 188. 30-year mark is sitting at 407. So the deduction here that we need to draw is that insurance is an instrument that increases your net worth right away. So from the day your policy is approved, your net worth is increased by that amount. So if you got a $500,000 policy, your net worth is $500,000 more as of approval date. But for instruments like your RRSP, TFSA, and real estate, it takes time. So the net worth grows over time. So they're all good, but you just need to balance and make sure that you do your best to maximize the immediate net worth as much as possible. So when I talk to my clients, I encourage them to maximize the insurance, so that way they have a high net worth right away, and then you can grow your long-term investments over time. Okay, so that sums it up. I just want to do a call to action now. So again, give me a call at 780-680-1334. Let's take a look at what you have. Let's review your plan, and let's focus on maximizing your net worth as quickly as possible. Again, insurance, those who understand the power of insurance can actually really benefit from it, because once your net worth is high upfront, then really you're not too stressed out about if anything happens in the early years. That's critical. And so let's increase your financial confidence. So please share this with all your friends, family, and don't forget to subscribe. Thank you so much, and have yourself a good rest of the day. Thanks.